Welcome to the Capital Discussions Road Trip Trade Alerts Weekend Update. I'm Tom Nunemaker with Dan Harvey. Just a few quick things before we get started. On the classes page, I renamed it from Dan Harvey and Tom's Road Trip Trade Alerts, which was kind of long, and when we were sending out emails and different things, it was getting, people actually were not seeing the rest of the email subjects because it was so long. I just renamed it to Road Trip Trade Rut and Road Trip Trade SPX. So they're not up here where they used to be. They're down at the bottom now. So it's all sorted alphabetically. And if you click on them, you go to the correct class page, obviously. One thing I did do, Dan and I had talked about on these global hedges, like the global put that Dan put on recently for RUT and SPX. We needed a way to account for any profit or loss that those made for each individual trade. So what we did is we're allocating the profit or loss from these hedges into each trade like this. So you'll see a bracket underneath the P&L on the open page. If there's anything that's being added or subtracted from the position's native profit and loss, like that, this is actually from the hedge. So in the Russell put, that made $1,160, and there were two trades open when we put the hedge on. So that 1160 was split across two trades. So if you look at the P&L and option view, this trade is actually down $2, but because it made 580 with the protective hedge, the net P&L for this trade is at 578. So this answers some questions that people had, like, well, my P&L is different than what you've got, and this is probably why, because we're adding in the case of the RUT, the profit we made. And in the case of SPX, we closed it for a loss, so we're subtracting 343. So on this 29 July, the option view is going to say it's up 713, but we have to take off that 343, which leaves the net of 370. So that maybe a little clarify of how we're doing that.
So yeah, and I think, as Tom said, he and I talked about the various ways of doing this, and Tom, if you want to show the equity curve while I'm saying something here, one of the reasons we decided to do it this way was so that we would have a more realistic and reasonable looking, equity curve, which, as you can see here, does reflect our loss. I will say Brexit-related loss. Mainly from the 1 July position, which I've already gone on record saying I probably could have handled that a little better than I did, but hey, nobody's perfect, and it was a weird environment. But anyway, I don't want to make excuses. But the reason we're doing this the way we are is because otherwise, if we just regarded the global hedges, either gains or losses, separately, I think you'd have some huge, inflection points noted in the curve, don't you think, Tom? And that I don't think would be realistic.
Yeah, I think this is a better way to do it, to average it out and apply that loss or gain to each trade that the hedge was protecting or trying to protect.
Right, and I mean we're being very upfront about it. I mean, because the ones that I'm identifying as a global hedge, which is either going to be a put or a debit spread, will be so designated and then will be, allocated accordingly as Tom described. And, it is what it is. Now, fortunately, I had one question from someone yesterday that was a little confused about the nature of the global hedge and why are you even doing it. And the reason for doing it, and we don't do them very often, fortunately, the reason being when you have some sort of an event that is a huge event, possibly of a global nature, such as Brexit was, we have to have more than just the cycle-specific hedges that I routinely put on. We have something. We need to have something to keep us from having a cataclysmic loss. So these aren't going to happen very often, folks, but we do have to have some way to do the accounting. And so this is the way we're going to do it.
Very good. So I think that's it for the new things we need to talk about. Let's jump into the positions themselves. So this is the July 30th or 29th expiration. So we're up 793. There is that minus 343 that from the global put, but the trade's looking fine. I mean, we have plenty of room now. We've shot way up, so there's not a lot of risk of coming back and getting below the tent at this point. So I would anticipate, pretty soon we're going to be doing some reverse Harveys on this to lift this up a little bit more.
Right, exactly.
And let's see, the probability of touching is 23% of the short strike. So that's, starting to get into safer rather than more dangerous mode, which is good. Anything else on this one, Dan, before we move on?
No, I would agree with your assessment. We are going to have to do the reverse Harvey on this. And I might, point out that I think I've said this before, and I think you have as well, Tom. Everybody should be keeping a trading log of their own, personal trading, their successes and failures. They can do it on a spreadsheet or in a notebook, whatever you're comfortable with. And within that log, you should include your trading plan for tomorrow, for the next day. What are you going to do? What if? So you want to. So for example, on my log, it says on Tuesday the ones that I am planning to do the reverse Harvey on, and the ones that I may wait on, and the ones that I'm going to be watching. And when we were going through the Brexit crisis, I had in my trading log, I have got, something to the effect that I've got to bail out of the 1 July tomorrow, if the market does not do such and such. And this is the sort of thing that I think it's a good idea to learn to evaluate, once a day. One of the nice things about the road trip trade is really, well, obviously when you put on a brand new trade, you can just sort of forget it for 15 days or so, maybe even longer. But once you have several running in place, you do need to look at them at least once a day, and I would recommend mid-morning as a good time. You can look at them more often if you want. But anyway, every single day you do need to evaluate them for the day, for the following day or two. What are you going to do? Is the trade hurting you? Is the trade nicely profitable and you're going to maybe take off half and let the rest run in the yard? Whatever you're going to do. But I think a trading log is a good idea, right, Tom?
It is, and I always remember what my 8th grade teacher said. You remember the questions on the test that you got wrong, not the ones that you got right. So the trading
Right.
log is a good way to help you remember those losses and maybe help figure out what you're doing wrong or right, or how to make the losses a little bit less the next time, or maybe even avoid them.
Well, that's exactly right. And the same thing really in our day jobs when we had them. I mean, I remember uh, when I was a diagnostic neuropathologist, I remember my mistakes. Fortunately, never killed anybody, but I made some mistakes like every other doctor. And, 30 years later, even longer, I still remember them. And I remember exactly what, happened and the consequences. The worst thing that ever happened was that one patient had to be reoperated on, and it was entirely my fault. I made the wrong diagnosis. So, like Tom was saying, everybody remembers this, so it's a good idea to write it down so you'll remember it for your future trading.
All right, so I think we've covered this trade pretty well. Let's go on to the next one. This is our August. I'll do it 4 times to get back to my favorite color, blue. Let's see where. Let me make this
You
a
like
little
that
bit
blue,
wider.
don't you?
I was a pilot, so my favorite color growing up was sky blue, and
I
my
see.
favorite animal was a bird, and I was there's an aviation flying theme in there somewhere.
Yeah, I see something related here.
Yeah. Okay, so here's our August trade. I guess kind of our problem child. It's I guess the max loss at expiration is about 1,000. Um, but we're not too far from that. So even if the market runs up like crazy, we're not going to lose much more on it. So the risk right now of losing more is very, very low. So the two standard deviations are down here at expiration. So it's getting safer to reverse Harvey, and I think we need to pretty soon. Otherwise, we're going to start running out of time. But we still have 49 days to go. So
Well, I would agree. And Tom, if you could please magnify that area where the
here,
wand is. I wanted to
okay,
point something out that, and we've
that
had
enough?
several questions. Yeah, we've had several questions like this in the past, but so maybe this will address those questions. Um, it really is more of an art than a science to know when to reverse Harvey these things and lift these and lift the lines up so we don't go to expiration. What I would point out though is notice that where the wand is, and even slightly to the right of the wand, um, the lines are all converging. So that's the max that you're going to make where they converge, number one. And number two, uh, you're not making much more from time decay. So once you've determined from a probabilistic point of view that it's reasonably safe to reverse Harvey, then go ahead and get started and begin to lift these lines up. Now, conversely, if we dropped off to, say, 2080, for example, you see there's more money to be made by letting the position run. Remember that when you do when you do the reverse Harvey on both sides, you're giving up a little profit potential on the debit side of the butter, and you're giving up some of the credit that you've already received on the credit side of the butter. So that's the main reason you don't want to do it too soon, because you are taking the cookies out of the cookie jar maybe a little too soon. But once the lines all begin to converge, and once you determine it's reasonably safe to begin the process, then that's the time to do it.
And sure looks like they're converging. You can see here the theta line, this one right here, it's at 22 right now, but you can see it's dropping off as the market rises. So you're getting paid less and less time decay as you go up. So it's a good indicator that the reverse Harvey time is near.
Right. You always want to look at the theta line either on OptionView or one, or even on Thinkorswim. You can change the settings to look at theta. And if you're not making any more, and if it's relatively safe to begin the process, then do it. But I would recommend doing it fairly gradually, because you never know when you're going to have maybe a one standard deviation move to the downside. And if you have left a few cookies in the cookie jar, you can capitalize on that.
And it's the same thing when you're making adjustments on the downside. Some people, especially newer traders, like to completely get flat on their deltas, but a lot of times the markets will reverse on you. So you generally don't want to get completely flat unless it's some kind of meltdown like Brexit. But in a normal market, when it's moving down, just cutting the deltas in half or 2/3 is usually all you want to do. Again, because the markets don't go in one direction all the time. All right, so we only have one more open SPX trade. That's this one, the end of August trade. And maybe to zoom out a little bit. So this was the one that Dan started with a credit. So if you look at the profit chart, the birdie, as Dan Sheridan used to call it, extremely wide profit area, and it's looking in the standard deviations. Even 2 standard deviations is already inside the expiration tent. We were looking at the on the open for SPX. You can see this trade is nearly 2 standard deviations at the edge of the 2 standard deviation probability cone, and as Dan pointed out, it was actually briefly above that on yesterday. So this is really shot up, and it's actually looking like a pretty good time to reverse Harvey. Again, these lines are converging, so there's not a lot of risk on the downside at this point with this trade.
Right. So this is in my trading plan. So be ready to see these alerts next week. I'm not sure which day. May not get them all done on the same day, but it's going to happen next week.
So this one's looking fine, and only one more open trade to go through. That's the Russell, and I can zoom this out a little bit. And let's see, anything else for this? Here's the expiration. Okay, so here's our open Russell August 18th trade, and it's showing down minus 172. Remember, we had the benefit of that plus 580, so you'll see a profitable trade if you look at the open tab. But the trade by itself, without that additional $580, is that technically underwater, but not by very much. And even at expiration, if you let it go, you'd still be down less than 500. So even with that plus 580, you're going to make money net on this anywhere above here. But again, this is one of those trades. The market has run up quite a bit. There's still 49 days to go, so still lots of premium to play with. And I think the reverse Harveys are coming on this one pretty soon.
You bet.
And Dan, did you want to take the ball to, or just talk about the September trades, or maybe another August one? I don't know what your plans are.
Yeah, I'll go ahead and take the ball, and I want to show a couple things. We have a few minutes since we had relatively few trades.
Okay,
Oops.
You've got the presenter.
All right. It's showing that. Yeah, you should be able to see me. So yeah, before I start, I thought I would show something that's kind of amusing, and I have to say in advance to our wonderful subscribers in the UK, no offense intended on this. We love you, but perhaps you can see the humor in this. And Tom, I know you're a big Monty Python fan, right?
Oh yeah, I've got Monty Python and the Holy Grail practically memorized.
I know you do, and well, I like it too. And so the cover of the New Yorker this week looked like this, and the title is
Silly Walk. Yeah.
The title is The Silly Walk Over the Cliff.
There we go.
And just for fun, I went back and looked at a couple of YouTubes on Monty Python, and I like the one where he, I think it's Michael Palin, is going into the Ministry of Silly Walks, and you may remember that, and he encounters several people in the hallway, and they all have their own variation of silly walks, and then he goes in, and somebody's sitting in his office who is making an application for a silly walk. But anyway,
yeah, I remember that. That was good.
So anyway, okay, enough of that. So so I thought I would take just a couple minutes here and show the way that I approach, setting up a new trade, which will be coming up soon for the September cycle. It'll be the regular monthly cycle, so it's going to be very liquid. We know that in advance. So the first thing I do is I look at my chart. There's nothing magical about the chart. You see the Bollinger Bands, and so here's the Brexit thing, Yahoo, and we actually dipped a little bit, below support, but then the market miraculously, I guess, or greedily, found some legs, and we had a piercing bullish candle here, and everybody knows what happened after that. You started to, bounced off the lower Bollinger Band, and there we go. This is the implied volatility and and also the regular, historical volatility. The yellow is the implied, and the pink or the magenta, whatever it is the SV. And the historical is usually lower, but it lags. So now the IV is coming down and the SV is coming up. And when you look at it on a percentile basis, we had a big pop and now it's coming down. So we think volatility being a mean reverting entity as a rule, we think it's going to be coming down. And one of the things that I like to use is the GARCH for the projection of the future volatility. So I'm using Peter Hoadley's thing, and you get the data here from Yahoo, and it's based on 4 years. This may be hard to read, but 2012 to 2016, and you bring that in, and then you can get the forecast, and there it is. And I know this is going to be hard to read, but we're looking for the September trade, which we will be exiting in about 60 days from the time we get it on. So what this is saying, that even though the current volatility is higher, we should be using a volatility that is somewhere in the range of around 15, because according to the GARCH calculation, mean reverting, it's expected to go back down into the 13 range, and because that is where it has been. And indeed, OptionView uses something around a 13 now, I think, for its average volatility. So what I do then is I go to our calculator, and I'm going to put in a future date of the 1st of September, because that is probably where I'm going to get out. So I've got that in, and so now I'm going to put in a custom volatility, and I'm just going to make this around 13.8, and kind of split the difference between, OptionView and GARCH and whatever. The 30-day average volatility, let me go to 60 days, around 12.76. I think it's going to be a little higher than that. So I'm just going to put in around 13.8, but there's nothing magical about this. So we'll put that in, and then so the reason for doing this, what I'm looking for is to find my short strike. And I've already done this, so I'll save a little time, but if you haven't, you would experiment. And I have found that 2025 gives roughly a 50-50 shot of being touched. And this is about what you want. Actually, a little bit less would be ideal, but you don't want it too much lower than that, because you're not going to make enough money. So I'm looking for the 2025 short. That's a multiple of 25, so it's going to be very liquid. And the next thing I do is I go over to the Add Simulated Trades, and I've already set this up, and here we are. So I know I'm going to be looking at the 2025, and what I like to do first, and we've never talked about this, I don't think, is that I like to set this up as a ratio spread, because remember, a broken wing butterfly is really a ratio spread, +1 -2, to which you have added what many people call a garbage tail, or a garbage put. So we're looking at the 2025 as a short. The current market here is now 2100, so we need to pick a long someplace, and I'm just going to do 2075 and then two 2025s. So we're getting a lot of credit, and it's going to look something like this for the ratio spread. Lots of credit on just a one lot, but obviously we're going to have to buy a garbage tail here because this is way, way too risky. So so what you would want to do would be to experiment, and you're going to want to obviously make this a broken wing. So the first thing is to look at somewhere around the 70, 65, 60. You'd want to choose one of those strikes, and you'd want to look at the open interest. Not a lot of open interest in the off strikes, but there's a lot of open interest in the 1950. So let's see what that looks like. That looks pretty good to me, and that's for a one lot, and I'm in my Reg T account. So you see that's using a roughly 24.75. So we can pump that up and maybe get a 5 lot. And these are the Greeks. That looks pretty good to me for starting. And when you look at it on the day steps, this is what I like to see. When I first start something out, I know that the family of curves is going to be falling off a little bit on the downside, but I don't want it to fall off, a lot. And when I'm first launching a trade, I don't want the upside, to immediately begin to fall off. I want it to be relatively flat, the entire family of curves, so that even if we run way up here, I know I'm still going to make some money on this trade. So that would be one possible consideration. Now let's kind of change this up and do one more. And let's try instead the 2060 for the upper long. It's fairly liquid. It's got 23,000 open interest, and we're going to keep our 2025 short. And so now we need to add something for the garbage put. We're not going to want to keep the 1950. Let's take a look at either the 1960 or the 65. I've already done the 65. And now once again, you have a little problem here. This is not so liquid. So you'd want to, maybe try this. You see if you get a fill, if you like what I'm going to show you. And if you didn't, then go to 1960. So we'll look at a one lot of that first. And it's going to look like this. And so we're selling this for a credit. Now, this doesn't look so good here from a downside risk point of view, but let's go ahead and pump this up to our working margin, which you can see here is 12,480. But we have to do something to manage this risk. So you can either bring in the lower wing, which is perfectly fine. In other words, move it up. Maybe move it up another 5 or 10 points to see what the curves would look like and what your credit would be. When you look at the family of curves, it is really pretty obvious you're dropping off way, way too much for the entire family of curves. So that's one possibility. Another possibility is to go ahead and add a debit spread from the very beginning. Either put it in as a good till canceled order, or just go ahead and buy it right after the main part of the butterfly has been launched. So you'd want to play around with some possible strikes for the debit spread. We're currently at 2100. Just in the interest of time, I've already sort of played around with the 2090 2065. And when you add a couple of those, you wind up with a fairly good looking position. Notice how this also reduced our margin requirement. So we can add a couple more to this. So now we've got something looking pretty good again. When we go to the family of curves, now we see something more that we would like. So now what you would do, and I'm not going to take the time to do this right now, but you would want to compare from a P&L point of view. You'd want to compare the first one I showed you, which had the upper long at 2075. You want to look at the P&L, along the family of curves, and you might want to adjust this so that the yellow line is closer to the 1st of September when we're planning on getting out. And you'd want to look at the P&L you would get, anywhere from say 1,500 to a couple thou or 2,500 if things work out right. And you'd want to see which one looks the best for you, not only within the fat part of the curve here, but also which one looks the best if we keep running up. So anyway, that's just a little short synopsis of the way that I like to approach this. And Tom, you probably have some variations on this theme. Do you want to comment on anything?
Well, just a question. I know some subscribers are probably going to ask this. Is this something that you're going to be doing in the future road trips, adding some debit spreads at the trade initiation?
That is a possibility if I can't find one in the conventional setup. I may add one either right at trade launch, or I may leave an order in place that if we drop off even a little bit, that it will fill.
Sounds good. Yeah, I like the family of curves approach of looking at things. It's don't have quite the same view in option view, but you get an idea from the P&L. So
right.
It's definitely worth looking at and making sure you don't fall off too hard or too fast if the market starts moving against you. And again, if you're going to be doing variations of this, an ES or whatever stock or index of choice you trade, then just make sure if it is dropping off a little quick that you put in some hedges either right away or good till cancel orders to keep from losing too much, because that's the key to this or any other trade. Just keep the losses small and under control.
Well, exactly, and remember that the Greeks that you're seeing, and especially the delta, that's just a spot view. That's like you take a camera and you take a digital photo, and that is what it is at that particular moment in time. But 10 minutes from now, if the market is moving fast, your delta will no longer be looking like that. Whereas you get a better idea from examining the family of curves as to exactly what would happen, not only now the same day, but 2 or 3 or 5 days from now. Well, in this case, it would be every 14 days. But if you set this up to be a smaller time frame, you get an idea of what would actually happen. And so, for example, for 5 days, you'd have to have a pretty good move to the downside to even wake you up. And
right.
that's what we like about the road trip trade.
Yeah, we don't want to be interrupted on our road trips too much.
Exactly. You got it.
Okay, Dan, I think we've covered everything, and thanks for that kind of behind-the-scenes peek of what you do when you're looking to initiate a new trade. I'm sure people really find it interesting.
Okay, I hope so.
So unless you have any other things to wrap up with, we'll wrap this one up for this week, and I'll get it posted on the member site. And as always, don't forget about the forums and the Ask tab if you do have questions. And I think when our monthly Q&A is still in a couple of weeks. Let me just check the calendar. It's the 23rd of July, so we still have a couple of weeks to go before the live Q&A. So if you have any questions before that, just let us know, and we'll try and either answer them directly or add them into our weekly review. So,
Sounds good.
Dan, I really appreciate you sticking with us, and hopefully you're learning something, and we always learn from you too. So, keep us honest, keep the questions coming, and we'll all try and figure out this trade together.
And I might want to mention that Tom and I are working on. Uh, we're not we're not sure when this is going to happen, but we are working on, adding some tools to the tool page, or you could call it a utility page, that you could go to and sort of get an instant glance of what's going on, maybe what I'm looking at, maybe what Tom's looking at. So that's kind of a work in progress. And once we have some things, Tom will incorporate that, and we will let you know.
Absolutely. So with that, everyone have a great long weekend. It's a holiday on Monday in the U.S., so everybody have a great 4th of July. Enjoy the fireworks, barbecues, and don't get hurt. So we'll see everybody next week.
Right. Thanks again.
Thanks, everyone.